There are three types of stock that all investors must understand before they start investing. I'll give a quick summary of them here, but I'll also link to more in-depth videos in the description. So investors who buy stocks typically do so for one of two reasons. They believe the price will rise and this will allow them to sell the stock at a profit, or they intend to collect the dividends paid on the stock as investment income. Of course, some stocks can do both, at least to some extent, but most stocks can be classified into one of three categories. And if you understand each of these three categories, it will really help you to grow your portfolio. So the first of the three is growth stocks. These are companies expected to grow sales faster than the market average. And growth stocks often look expensive, trading at high price to earnings ratios. But such valuations could actually be cheap if the company continue to grow rapidly, because this will drive the share price up. Since investors are paying a high price for growth stock based on expectation, if those expectations aren't realized, growth stocks can see dramatic declines fairly rapidly. These stocks generally don't pay dividends. This is because the issuers of the growth stock are usually companies that want to reinvest any earnings they accrue to accelerate their growth in the short term. So the key takeaway here is that growth stocks are companies that expect to grow sales and earnings at a faster rate than the market average. They may not even have earnings at the present moment. They may have unique product lines, hold particular patents or access to technologies that put them ahead of others in their industry. But they reinvest the profits to develop new technologies and patents as a way to sustain longer term growth. Because of these patterns of innovation, they often have very loyal customers or a significant amount of market share in their industry. For example, a company that develops computer applications that's the first to provide a new service may become a growth stock by way of gaining market share for being the only company providing that service. If other app companies then enter the market with their own version of the service, the company that actually manages to attract and hold the largest number of users has the greatest potential for becoming the growth stock in that marketplace. So the second of our three stocks is a value stock. A value stock is trading at levels that are perceived to be below its fair value. And common characteristics of value stocks include high dividend yields and low price to earning ratios. A value stock typically has a bargain price, as investors see the company as unfavorable in the marketplace. They often issue dividends as the company has less need for capital growth, meaning growth stocks tend to rely on cash for their development. So why are some stocks undervalued? Well, there's no single reason that a stock is undervalued. In some cases, stocks may be undervalued as a result of investor mood or market dynamics. Stock prices may drop as a result of unfavorable news or pessimism about an industry, for example, or a business or a market, potentially resulting in discounted possibilities to buy shares at a lower price. So our third and our final stock type are income stocks. These are stocks that offer regular and steady income, usually in the form of dividends, over a long period of time with low exposure to risk. So income stocks usually offer a high yield that may generate the majority of the security's overall returns. The ideal income stock would have a very low volatility, a dividend yield higher than, say, a typical government bond, and a modest level of annual growth. Income stocks are different from growth stocks because these have higher volatility and risks associated with their performance.
If you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose, and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The All World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.